The purpose of the Global CFO Council is to provide an educational and networking forum for senior financial executives in order to share best practices, discuss current financial issues, and to learn about current topics related to the performance of their jobs.
Joe Watkins,
Oh,
can you hear me, sir?
I can indeed.
Man, even put on a coat for the event. Very professional. I like it.
Like we say in banking, it's a real tie and a clip-on suit.
Well, Joe Watkins is the Director of Treasury and Management Market Performance at Pinnacle Financial Partners. Is that correct, sir?
It is indeed. Thank you.
And I thought kind of Pinnacle just jumped on the scene a couple years ago, but I think it's because Pinnacle, which is out of Nashville, bought BNC, the Bank of North Carolina, which if you're from Carolina like myself, you've heard of forever. Is that right?
Yes, that's right. Actually, I was a heritage BNC person for that acquisition.
And it looks like you got a very long career in banking and treasury. I think you're out of Charlotte, North Carolina. Is that true?
It is. Yes. I kind of tell folks if there was a cash management Mayflower, I came over on it. That's how long I've been.
Undergraduate degree, business administration and finance from UNC Charlotte. Is that true?
Yes.
And Joe, this is a little sad. So I don't read bios. I just find interesting things on the internet about people. And I couldn't find anything. And I spent a lot of time looking. And so you're like whatever you're doing to keep yourself off the internet, you're doing a good job. But I think that you have 2 kids, and I think that you like to make cocktails and a little bit of a barista, a little bit of a cocktail expert, maybe.
There is some truth to that, but that is on Christmas. I'm sort of established as like the bartender for the day. So obviously when we had smaller kids, we didn't do this, but as my kids are older and out of college, and so throughout the day, I about every other hour I'll make a holiday cocktail on Christmas Day for the family gathering.
Well, I'm getting to the point, my kids are getting old enough, they're teenagers now, that I need to drink something about every hour during the holidays. So I may ask for some tips at the end of your presentation, but we're going to focus on treasury and cash flow management right now. Joe, I'm going to mute myself. I'm going to be an active participant. And then halfway through the presentation, give me a pause. I'll hit you up with a few questions. And at the end, the rest of the questions. And I look forward to your presentation.
All right. Thank you, Robert. So I'm going to jump into the objectives here. First, I'm going to talk a little bit about illustrating provider. And when I say provider, I don't mean that from sort of a medical terminology standpoint. I mean that from a bank, financial services context on treasury and cash flow. I'll talk a little bit about practitioner objectives on the client side, i.e. the participants here. I'll talk a little bit about the cash flow cycle and our interpretation and use of it. And then I'll sort of transition over to a discussion that kind of maps that over to actual treasury management solutions for the cash flow cycle. I'll talk about industry trends and then some closing comments around, my thoughts on selecting a transaction banking provider. So first slide I want to cover here is this. I actually use this in training some of my internal line partners, and not to insult anybody, but just to kind of explain to them the world of treasury and how it's kind of different from accounting, because in a lot of commercial banks and diversified consumer and commercial banks, you've got a lot of internal constituents that deal with retail and consumer clients. So their expected literacy around things that deal with commercial clients is maybe lacking. So this is a kind of a way where we kind of explain, okay, treasury and treasurer kind of deals with the world where there's not really as many formal rules and regulations versus accounting where there is. There are certifications available for people in treasury functions, CTP, AAP, whereas on the accounting side, it's more of a formal licensing as a CPA. There isn't any defined curriculum in college for treasury. There's certainly things that facilitate knowledge building in treasury versus, I think accounting now probably in college is really more of a defined kind of 4 or 5 year program at least. Treasury is kind of deals with broad responsibilities. Accounting tends to deal with more defined responsibilities. And here's where it gets a little bit, some of these are obviously can be debatable, right? But when it comes to cash flow, in the world of Treasury, it's collections and payments versus an accounting world, it tends to be cash flow, includes depreciations, is a little bit different approach there. And cash itself to a treasurer is available, collected in ledger balances versus cash and cash equivalents. And treasurers, there's probably some shared sort of responsibility here, but they tend to deal more with bank and fintech relationships. Probably this slide would have read a lot differently many years ago because now there's huge amounts of organizations that provide payment solutions that either supplement or in some cases actually replace bank products versus accounting and controllership duties tend to kind of focus on auditor relationships. So a little more context now when I talk about, from a bank perspective and a provider perspective, this is where I address, this notion of there's kind of an approach that banks can use with businesses where it's very transactional. You go in and talk to a company, you get some information about the products they use at their incumbent bank and what they cost, and then you immediately jump to this whole notion of, well, let's just match up what you do at your other place. This is what we charge. This is what's in my tool bag, end of discussion. And, I can say for what I would call like sort of contemporary banks, that approach to doing business with commercial clients is not really effective now. It's really transitioned into discussions that deal with account structure, segmenting and managing cash, account visibility, account controls, working capital, supplier relationships. Those kinds of conversations sort of facilitate what I sort of have on the right side of the slide about all the functions and dimensions and aspects of what practitioners do. Because really, you're not sort of approaching those discussions using the approach sort of on the left side. You're not really going to get to what I would call more insight-oriented, deeper discussions about Treasury. And you'll hear me kind of allude to that in a couple other places here as I kind of progress. I want to make sort of a final, yes, sir.
Just wanted to let you know something is rubbing up against your mic. It might be a piece of paper or your hand, and it's just a little bit of sound, a little bit of scratching. I just wanted to give you a heads up.
Okay, certainly. Might be some background here. So what I want to kind of emphasize here is the point kind of a little bit further is this is a great graphic, and there's some places here in my materials where you'll sort of find I'm a big fan of infographics, and sort of the lower left-hand piece, you'll see that in terms of like the scope of Treasury management, there's the world of compliance and control and efficient and effective processes, which pretty much everybody expects everybody to do. But the more value-enhanced Treasury and strategic Treasury, and sometimes I'll kind of oversimplify it and say that's where we get into discussions of things about process behind the Treasury. That's where the real value lies in terms of process transformation, business continuity. This really differentiates providers in front of businesses, in my opinion, because with the sort of proliferation of technology, a lot of commoditization, everybody can do a lot of the things in the compliance and control and the process area, but when it comes to the advisory people element of the value-enhanced strategic Treasury, that's where the real sort of differentiation occurs. Switching over a little bit more now to, this is all great from a bank perspective, right? But, we're not delusional. The reality is we have to look at the grounded world of what businesses have to do every day and what they have to accomplish. And it's incumbent upon the bank to engineer our approach, not only sort of from the advisory context that I provided earlier, but also from sort of a literal desk process. Regardless of organizational size, a lot of these, how do you collect, how do you pay, how do you manage your cash position can be reduced to that sort of next level. Who paid me and what did they pay me for? Can I match each of these transactions to my records? What is my cash position? And for that matter, how do I figure out what my optimal cash balance is? What level of forecasting do I need to do? What tools, what technology I need to do to accomplish this? When can I release funds, which we call sort of on the bank side is loosely known as kind of payment throttling. And then lastly, how can I mobilize funds for more efficient payment, investment, and borrowing decisions? And so now I'll transition a little bit to this discussion about cash flow cycle and related terms. So really this deals, we like to use this on the bank side because it's a great way to kind of frame the sort of collections, payments, day sales outstanding, DPO concept. So it refers to the activities and timing of the cash flows around those sort of foundational functions. The cash conversion cycle is really a measurement of liquidity, obviously how long a company has to finance a cash outflow before receiving a cash inflow. Sometimes I'll show a slide that's an example from Amazon. They call it the Amazon cash machine where they almost have like a negative cash conversion cycle. Their payments to their suppliers are extended well beyond their collections from the sort of public that buys from them. But nonetheless, a lot of times this is used in conjunction with the terms, kind of working capital because it deals with current assets and decisions and strategies around those. But I do make a little bit of a distinction here about cash flow cycle and operating cycle, simply because operating cycle tends to kind of deal with materials and resources around sales volume. They're all intertwined, but I do make a little bit of a distinction there. And then, cash forecasting is sort of, it's kind of inarguable. It's based on the understanding of both of those things, operating a cash flow cycle. As I mentioned before, I'm actually, a big fan of infographics, and I show this because it's just an illustration of what I've talked about. But the point I actually want to make here is about the use of infographics itself, because what I found is, and I would tell any company this regardless of what provider they're talking to. It's, being in Treasury for the amount of time I've been in and working with all kinds of different organizations, multinational down to micro business, there's a lot of value in this notion of, don't just tell me, show me. So what we find a lot of times is these organizations, we'll put all this material together, all this long narrative, and it really helps to kind of convert those stories and what we're trying to explain, the value proposition, the product, et cetera, into something where they're like, just show me where the data and the money moves and when and how it does it. Because a lot of times you have to appreciate some companies are really busy. They don't really have the time to kind of devote to kind of memorializing this, into some sort of format that they can share with other people in the organization. So we find that kind of taking this concept of cash conversion cycle, overlaying product solutions on it, and where those timings and the payment flows occur is really valuable. So I would say from a best practice standpoint, that's something if I was an organization, I would expect my bank to be prepared to do. It goes without saying as well that, it's cash conversion cycle really is the mathematical computation around it. It's kind of based on the presence of inventory. So I just want to make a comment a little bit here about it does apply a little bit differently to companies that don't have needs for inventory management, i.e. a service company, software companies that operate through licensing or insurance brokerage. There's a sort of a panoply of entity types where inventory isn't applicable. And, there's some debate about, well, can you just adjust the formula to take out inventory and kind of move forward? And you can to some extent, but the good thing about Treasury in particular is the value for those solutions work, whether it's a service provider or an organization that sort of manages direct inventory. Why is this important? Well, improving working capital really is about targeting and disposing of waste in the cash conversion cycle. Obviously, we want a lower cash conversion cycle. And once, you can identify the amount of capital that's tied up and you can quantify it, and it sort of illustrates what level of trapped cash that exists sort of in the organization. I say many times and use the phrase that, trapped cash is a force multiplier. Treasury solutions are a facilitator of that. They can help transform working capital goals into actionable, measurable benefits. And I think that's actually a best practice too. And I'll sort of hold my own organization accountable for that, just beyond sort of the generic topic is that, when people are promoting solutions to you that create efficiency or savings, et cetera, it's incumbent upon the person promoting that to provide evidence of that, in the math to show you, okay, yeah, it's great in concept that something's, efficient, but, show me in numbers what that means. So I think that's, I know at some banks, they've sort of taken it to the level where they provide guarantees for savings, et cetera. And, make no mistake, there are consulting firms that are outside the financial services realm that charge $200 to $400 an hour to come in, and sort of do these activities and have these discussions with companies where, this same information is what, banks provide for free through their treasury management departments. So I just want to kind of emphasize that. Let's see here. In terms of relationship to treasury management, again, nobody panic, I'm not going to read through all this, but I sort of put this here for a particular reason. This is also something I emphasize in training about, demystifying treasury management for people that don't really work around it as much on the bank side. But in particular, to kind of simplify everything, we kind of reduce it down to that middle section of collections, payments, and cash position management. And make no mistake, we don't portray that the complexity or the scale of those activities are minimized, whether they're a large company or a small company. There's a lot of variation in what goes into that. In particular, if a company's got, decentralized operations that span the globe versus, a small organization where the CFO is actually the owner too and does everything for the company. But, in general, you can reduce those things down to those three activities. And why we like this is that, when you talk about those three elements of treasury and the cash conversion cycle of working capital, what that does is it opens the conversation up to more, again, deeper insight-oriented discussions and not just matching individual things and having that generic discussion with, sitting down with a company, and if the only interaction you have with them is to ask them what their pain points are, as a provider, you're not trying hard enough. So we found this is a great beneficial strategy for us and the organization to deepen our relationship. So I want to kind of transition more to a little bit more specific application of this. And, okay, what does this all mean in actual product solution sets? And I use an infographic here for this as well. So we kind of map these out on the collection side, common products. And I'll go through these in just a second, but this is sort of the DSO and the DPO solutions as they reconcile to the world of Treasury. On the day sales outstanding side, I'll just touch on these briefly. Obviously, merchant services, common product at most financial services organizations. It's a business-to-business, consumer-to-business collection solution. Those products have been rendered in, sort of terminal, virtual terminal, online and mobile now. Lockbox, mail intercept solution for check payments primarily. There are different sub-kinds of lockbox: wholesale, business-to-business, retail, which is consumer-to-business, which, by the way, has been replaced by a lot of consumer online bill pay. So there's electronic lockbox that consolidates those payments from consumer bill pay to providers like utilities, et cetera. Medical lockbox, which provides kind of the full spectrum of revenue healthcare cycle management. And that's become a really popular product lately because while it tends to have been the domain of people that are receiving large amounts of checks, it's also an outsourced solution. So company that's tried to rely on managing a lot of checks on their, on-premise, found out that last year that became very difficult. So you'd have to go to the office and figure out how to manage all that. Well, so the value proposition for Lockbox has kind of expanded, in particular against the backdrop of the pandemic. Remote deposit, that's sort of a popular product as well. Not designed for high volumes of checks received on premise. I didn't specifically mention image cash letter, which is sort of another solution that kind of sits in between remote deposit and Lockbox at most banks, where clients can capture a large volume of checks and actually assemble what they call sort of an X9 file. It's an image cache letter file that's similar to what comes out of lockbox and remote deposit that goes into the bank's core processing system. Armor, Courier, and Cash Safe, essentially deals with coin and currency. Those services have been around for a very long time. It tends to be managed by sort of an oligopoly of organizations now, Brinks, Loomis, et cetera. Essentially, all commercial banks partner with one of those organizations. It's not an in-house developed solution. But there has been some more popularity on the remote cash safe solution for organizations that actually want to have a device where they can deposit those notes, and they get provisional credit for that before the actual money is moved and settled and reconciled at the bank. And then ACH debits or drafts on accounts, one of the more popular DSO collection utilities. Robert, I didn't know whether, this was a good time to kind of stop in terms of questions, et cetera, so just let me know.
Perfect time. They are piling up. So this is a perfect stopping point. And Joe, I'd also like to say this whole presentation makes me think of my favorite quote I have on my board in my office wherever I work, and it says, "Revenue is vanity, profit is sanity, cash is reality." And I make the salespeople turn around and read it whenever they tell me about some new great opportunity where we're losing money, but we're going to make it up in volume.
That's right. That's right.
Also, I was quite impressed. You used, I had to look up panoply. I had never heard that word before. I now will be using it all day, and I will find reasons to put that in a sentence. That is an impressive collection of things, if anybody was wondering. And payment throttling. I always thought what I did is just not paying people on time, but now I have a fancy word for it, payment throttling. All right, I like it. Okay, so Joe, in no particular order, question numero uno is, you mentioned earlier on about Treasury management, and there are some certifications. The question was around for company treasurers at firms, any suggestions on the best certification or training for Treasury professionals, maybe a new Treasury professional entering the field, or somebody we're just about to hire, a Treasury person. Who should we be looking for?
This is opinion, not fact, but I will say in particular the CTP designation, Certified Treasury Professional, is really good. I mean, there's like accredited ACH professional, which is more of a tactical one. And there's some AR and AP certifications that are sponsored by some organization whose name escapes me, but I think the CTP is the best one, and I'll tell you why. That actually is a very difficult test. I took it many years ago when it was actually had a different acronym, but what's great about it is it exposes you to this like very large kind of global organization of practitioners and banks together. They sponsor all types of, ongoing training and webinars, and they have an annual conference. And, a lot of people sort of joke that and this is all sponsored by the AFP, Association for Financial Professionals. They have a big conference usually every fall somewhere in North America. And, a lot of people kind of joke that it's like a big trick or treat party with exhibitors, et cetera. But I can tell you the sessions are very good, and the amount of stuff that you get exposed to sort of outside your biosphere is invaluable. So I'd say CTP.
That sounds like a wild and crazy conference. Treasury management professionals all together in one place. That must be awesome. Question number 2 is, earlier in a slide you mentioned that separation and sometimes line demarcation within firms between accounting and treasury. Seen any conflicts arise between within firms with treasury professionals, maybe with one set of goals, and the rest of maybe the controller or even the CFO? You seen any conflicts, any examples, or anything to avoid so that conflicts don't arise within firms?
The one that I would probably cite, and it might be sort of not one you would imagine, I think has to do with, because of the amount of development and fintechs that have developed payment solutions and value-added solutions, in the world of payments. I think a lot of times, people in those two different functions may have sort of divergent opinions about, should we put all of our emphasis on using bank solutions, or should we buy a Treasury workstation, or should we buy an ERP system? So I think decisions about how much to rely on bank solutions versus what I would call like a point solution or an ERP system. And in those ERP systems, I don't profess to have, detailed knowledge of them, only to know that there are aspects of some of the more, complex and larger ones that can do all sorts of things, and they only rely on like bank data feeds instead of customers using the bank products. So sometimes we see issues within a company where they can't agree on which one of those kind of systems to use and how much of the system they want to enable to do what they do every day.
Joe, we saw with COVID, if we weren't tracking the cash conversion cycle before, we were certainly tracking it last year. Any thoughts on rainy day funds and how much liquidity a firm should have? I'm sure it differs between industry, but any sort of rule of thumbs, either maybe a percentage of revenue or a number of days of working capital. What are your thoughts about, once we're monitoring, are we just looking at trends, or are there some best practices and amounts?
That's an excellent question. I don't know that I'll have like a perfect answer for that, other than I can say that from just the materials and webinars, et cetera, that I attend, that there was a general sort of movement to trying to kind of bulk up what I would call the operating cash position. And just loosely, I'll say, I kind of look at it as operating cash as kind of the stuff you're going to need sort of short-term days, weeks. Core cash is stuff you don't want to get your hands on for like a month, and then there's like strategic cash that's not something you ever use for daily liquidity. I don't know that I could say there's anything sort of formulatic about that, other than I think people that experienced and measured their collections declining for various reasons from their trading partners, they sort of use that as a guideline to say, okay, well, our collections is X. We need to gross that up, gross our operating cash position up 2.5 times, because we just can't really rely on the collection pattern right now. So I'll give you a directional answer as opposed to kind of a forensic one.
And this is a long question. I'm going to paraphrase it into some thoughts on best practices about who's deciding payment terms, or who's involved in the payment terms process and the credit worthiness process. What advice do you give to your clients, say, around involvement in payment terms and credit worthiness? I think with this person's firm, the people outside of accounting, maybe the sales department, is heavily involved in determining credit worthiness and payment terms. So any advice or tips you would give to that person?
That's a great question as well. I think just from sort of what I've seen, obviously collaboration between any kind of Treasury department and sort of the accounting area and sales, I have noticed that given everything that's sort of transpired in the past 9 months, particularly for people that are, buyers, a lot of it has to do with sort of what level of concentration you have in those buyers. If one of your buyers provides 10% of your revenue, you're obviously sort of beholden to them. So I know that some firms have actually gone through kind of an organized process to kind of map out all of the buyers, what their contribution is, payment history, and quite frankly, it seems to be more of a qualitative approach, is that everybody's had to sort of mobilize and endure different struggles from the past 9 months. So, being careful not to disenfranchise buyers. So, i.e., some sort of relaxed payment terms in recognition of that. It's kind of, I would say from a qualitative standpoint, that's what I've observed.
And Joe, last question and then I'll hold the rest until the end. And it's and you can kind of just take this one and then advance with the slides. It was around when you had the previous slide up and it had little bubbles next to both the DSO and the DPO. It was which bubble is a good first one to review? Low-hanging fruit. You know, if you only had time to look at one of these things, and you're looking for some quick gains, is there a particular one of these bubbles on the left, and when you get to the next slide, bubbles that you'd hit first? And I'm going to mute myself and let you take it away.
Yeah, I would say any kind of activity that facilitates getting your trading partners or clients away from anything based on check collection, to me, is good. I mean, as selfish as I can be, that, transitioning collections from checks to other electronic means eliminates quite a few of the products on the DSO side, but I think discussions with trading partners to kind of eliminate checks and rely more on electronic payments, which have knockoff benefits in terms of not eliminating fraud, but electronic products, I think are inarguably more safe than that. So, and I'll make kind of a sort of a compliment comment on that here in a second when I go to my DPO slide. So on the payable side, solution set's a little bit more broad. I mentioned at the top here real-time payments, and I won't go into all the sort of minutia about it, other than it's certainly a solution offered by the Global National Bank segment, some super regional banks, and it's finding its way into other places. 24/7, 365 finality. I think right now there's some transactional limits imposed on it, but the comment I'll make about that is in a lot of the forums and webinars, et cetera, I've been in, real-time payments is sort of being talked about as being sort of the last payment rail standing. So at some point, there's a broadly held belief that all the different payment rails are going to collapse to RTP at some point in time. But at the same time, this whole notion about receiving payments 24/7, 365 doesn't really reconcile really well to a lot of companies' operations. And they're like, how are we going to sort of figure out how to manage our liquidity, even though there's benefits to that? So I'm putting it there as a kind of a solution set that's available that we see in the market. But there's obviously check-based payments. We make it known here that checks never die. Only the people that write them do, is what we say in banking. So they're just never going to go away. But AP automation, which is sort of the next infographic there, widely available product and financial services, huge value. There's a couple of different versions of that. I'm kind of generic here in terms of there's a sort of an invoice capture version where they digitize invoices. They put it in a desktop workflow for the client to kind of run it through their approval process and submission process. Different pay vehicles that they can select from, whether it's check, virtual card, ACH, wire, et cetera. There's a complement product, integrated payables, available. It's been around on the market for quite a while, where client will actually send the financial, the bank, a file of all the payments that they want to make, and it's not predicated on invoice capture. So that's I would say, particularly with the advent of all the impacts of the pandemic, people working remotely, pushing everything into kind of a digitized workflow, AP automation that has broad applicability regardless of organizational size. Purchasing in commercial cards, commercial card tends to be aligned with T&E purchasing card. Big value proposition there to transition AP. Obviously, they're on the recipient side. They're paying interchange, so P-card payments. You can't, as much as you want to move all your payments to purchasing card, commercial card, it's not always possible depending on your mix of trading partners. But that is one place where you can, divert what payments you can to P-card to earn cash rebates. So there's sort of a step-up value proposition there. ACH, been around forever. There's desktop, mobile, some mobile initiation channels, and also when I say MTM, I mean machine-to-machine direct transmission to the bank that doesn't rely on sort of a desktop package. Again, some evidence that payment rail is going to collapse eventually into RTP. And then, with the check-based payments, I've kind of sort of ring-fenced this thing about fraud prevention and to capture checks and ACH. Check positive pay has been around many years. I would say that any organization that has a reliance on check payments sort of has to have that solution. ACH positive pay, where organizations specify which entities can sort of reach in and draft their accounts and control that with sort of a decisioning tool. I can tell you, just talking to my network of constituents across many banks, given that I have been in Treasury a long time, that's probably one of the top most 3 sold products at every Treasury bank in North America. Wire transfer, high value payments, USD and FX denominated, these are all primarily desktop tools. They tend to, again, be aligned to more higher value payments, non-repetitive, repetitive, semi-repetitive, standing order wires. And then there's some cases where integrated payables through like an EDI format, the banks can ingest sort of a wire payment file without clients having to rely on desktop. But of everything I'm going to say about this slide, the most important one's in my little yellow sticky note. It is no secret that in terms of your payment protocols that if I had my competitor constituents here, they would all agree that the most payments you could push on the card, the better. If you can't do card, do ACH second and relegate check to last. I didn't put wire on there because that tends to be kind of a sort of a special use thing, but there is broad industry endorsement of that payment protocol. So I talked a little bit about cash flow cycle and working capital assessments, and I wasn't really at liberty to kind of stuff in all the sort of math and minutia about it, but I just want to kind of make a couple of comments that banks are able to go through and perform detailed working capital assessments for clients, where we take all the calculations and we sort of break it down into what the value is by decreasing or decreasing their AR days and increasing their AP days, and sort of calculating what is the value of that cash, or what is the amount of cash that's released for the client. Sometimes we go through those activities and we find out that, the amount of trapped cash in the organization is sort of unremarkable. There's available metrics and benchmarks that we can use to kind of compare that to at the industry level, but tends to be something that's worthwhile for companies that tend to be somewhat larger. And when I say that, I'm being sort of directional. I'd say, annual turnover of $25 million or less in sales. Working capital assessments, harder to kind of uncover a lot of value, but the bigger organizations could be significant value. So we've actually gone through one of these with a client, and it's kind of a generic one where, we found that there was about $93,000 in trapped cash. And you look at that and say, well, is that really remarkable or unremarkable? Well, it depends. Like I said, it depends on how that compares to industry benchmarks for that company, the mix of solutions. What did we really find when we went and did this analysis of their payables, receivables, et cetera? And even more importantly, that could be a big number for somebody. That could equal an FTE, not an FTE that was eliminated, but maybe an FTE that could be transitioned to a more value-added service inside of the company or function. But, one of the things that we keep in mind is, in order to get that, sometimes there are products that are added to kind of make that a reality. So you have to kind of consider, okay, well, when you sort of factor in the expense and the ROI of some of the solutions to create that, is it worthwhile? So there isn't sort of there isn't like a specific answer for that. It's all going to be sort of, based on like unique things that are at the company, I guess is the best way to say it. Industry trends, there's so many of them, and without kind of making it too overwhelming, obviously the fraud threat level, there's significant amount of information being circulated now about business email compromise. We see it all the time. I see there's some organizations we compete with where they have people that are carved out specifically to kind of talk about this. And so one of the metrics we picked up was, 87% of Treasury professionals indicated their perception of the fraud threat level has increased from last year. Obviously there's actually been an increase in ransomware, and it starts to become less a conversation about old-timey check fraud. It's all these other types of cyber kind of events. In terms of digital transformation, I kind of alluded to that sort of in some prior slides. Things that are kind of considered nice to have all of a sudden became like DEFCON 1, in the past 6 to 9 months. All of a sudden, everybody was not at the office, and all the things that we do and things that we depended on, we figured out. It's like, how many elements of what we do every day can be accomplished remotely, or even on mobile devices, et cetera. Like I mentioned before, people that were very reliant on having checks mailed to an on-premise location, where everybody was not at that location anymore, you have to send somebody to the office to pick up those checks and deal with them. Terribly inefficient, so I guess one of the benefits of the pandemic, if that's even possible to conceive, is that it's sort of opened up that there's probably some opportunities to look at some other ways of doing things. And so that could mean obviously a lot of things. Real-time payments is an example where that's becoming more readily embraced. And then the last one I wanted to kind of mention was this notion of human factor. The reality is that a lot of the technology in financial services is very commoditized. There's no secret there. But a product can't sit down with you and have a discussion about your strategy. A product is not able to be called when you have a problem or you need to kind of work through something. So this notion of the human factor continues to be sort of a significant asset and it's been made very apparent in the last 6 months in particular, when we've had organizations that have come to us and tell us what you think we should do, and no product matching that's going to occur is going to really help that. So I'll just emphasize that, and that is applicable to every provider of treasury and transaction banking services. So and I guess with that, I'll make a sort of a closing comment that in terms of keys of success in selecting a transaction banking or treasury provider, I listed service here in particular for the very reasons that I kind of emphasized a minute ago. And then secondly, this notion of, value-added insights. I have found that there's some aspects of the world of treasury management, because of the change in the advance of technology and everything around it, where this notion of domain experience from the provider side, i.e. the bank side, is really sort of heightened. So, in terms of an organization that is able to provide, there's a lot of times that's predicated on the individuals having a lot of experience, because this is a world, at least I can say from a treasury standpoint, no graduates, no degrees, learning never stops. There's always things that are changing. And in order to provide that kind of deeper level of insight, it takes a lot of time to sort of spend in this world to kind of amass that sort of business acumen. So, and I guess lastly, this notion about willing to look behind the treasury, comment that I've probably emphasized in some prior slides, that, it's not just about the products themselves. Working with a provider that can kind of look behind and get into the sort of processes to kind of uncover those opportunities. That's really where the value is in sort of those upper boxes in that sort of business advisory model slide. So, Robert, with that, that's kind of my prepared remarks. If you want to go to some more questions.
All right, Joe, I've got 9 questions in 9 minutes, so you got 1 minute apiece.
Whoa.
And I'm going to steal 1 minute to say something, is that we've got some large companies on the call, and there's large companies that are members of the organization. And I want to say, I've always worked at mid-market firms, and I don't mind, obviously, negotiating payment terms. But it is so annoying to me when, in the pursuit of best, practice treasury management, these very large global 100 companies have default payment terms of like net 120, 150, 180. And I think that's super annoying. So I just want to tell you, if you're doing that, that's rude and I don't like it. And now I will go on to the questions. I will read you rapid fire. So if you can answer quickly, that'd be awesome. And we'll get to as many as we can. Question number one, and I can't remember if you covered this certification. Somebody typed in here, what do you think about the CFM certification, Certified Financial Manager?
I don't know that I'm familiar with that one in particular, so I don't know that I could really comment on that. I don't see that one as common, I guess, in the Treasury space. So.
Question number two, with money market rates at like a basis point, 5 basis points if you're lucky, what do you suggest about optimizing the value of your short-term cash position? And with a little kind of / what are your thoughts about taking discounts by paying early?
I know on the short-term cash side, I only say this because I have some level of interaction with people that work at other organizations, and a lot of them are on the liquidity side, so they're a little bit agnostic. They'll promote bank liability products versus off-balance sheet money funds. I have to say, and again, this is not a directive, but there's been quite a bit of inflows into what I would call sort of the Reg D restricted money market deposit accounts. They tend to have, some banks have actually removed the Reg D restriction for the 6 debit. So when you look at the yields on those versus like a government or a Treasury money fund that's nowhere near that. The bank liability products are very strong, and I'll say this as well, that some information I've read indicates that for companies that are using balanced compensation with banks, they get what's called an earnings credit, which is kind of a contra account discounting tool. That's one of the highest valued uses of short-term cash to reduce expenses. So between ECR and MMDA rates, those I see those most common. Not as much activity on the money market mutual fund side.
Joe, further explanation about real-time payments. What does that mean? And an example, please.
Ooh. Yeah, my literacy there is probably not as deep in some other areas, but I will say that new payment rail, there are dollar limits. I believe it's $100,000 per transaction. It may vary by institution. It's eligible for consumer and business payments as well. I'm not as literate with the level of addenda that comes with that. And again, the pricing is going to vary from organization to organization. My suspicion is that because of its finality and it being 24/7, 365, that it will be a premium price per transaction versus a selection of ACH. So it's you'll see a lot more organizations taking advantage of it. Again, I think some of the complexity is when you line up the speed, the amount of addenda, and the transaction limits. I mean, you basically have to do a comparison matrix of the choices to figure out what's right for you.
You talked about working capital assessments and at the organizational level. Any thoughts for some of our larger firms to drilling that down? Have you seen working capital assessments drilled down to divisions or to special projects? And any tips about that?
That I have not, only because my particular experience has mostly been with privately held companies that are sort of 100 million in sales. But I would definitely imagine that companies that are large corporate, there could be, justification for doing those at a unit level or a line of business level. As far as, the way that it's done at that level, I think is somewhat consistent from bank to bank.
Joe, you talked about strategic dollars, those dollars that are not needed for, say, this year's operating. Any best practices for investing those dollars? Anything you would suggest to members of the council?
I had a little bit of experience in this in sort of my prior life at a larger organization where we had people that were bank liability salespeople, fixed income, term repos, sort of overnight things. But when you get into what we call strategic cash, it has different names, but it's, all part of the widely held, concept of cash segmentation. When you get into, strat cash kind of money, my impression is that it would make sense to interview multiple providers of those solutions, because basically, you would see that you have an investment policy or conditions around that, provide it to those organizations or those individuals and say, this is a separately managed account. How do you suggest we sort of manage the liquidity, safety, yield kind of factors on that, and have them, make the onus on those recipients of that to come back with a recommendation. So professionals that work with institutional liquidity, getting more than one opinion is what I would suggest. As far as the underlying instruments, there's short duration bond funds that seem to be popular in there, but I can probably speak less to what they're comprised of. It's more important to go to multiple folks to provide recommendations and how they would solve that for you.
Joe, the last question I'm going to ask, there were a bunch of other questions I'm just not going to get to, so I apologize to the members. But last question that we have time to ask. You mentioned fraud and fraud concerns. Anything emerging specific to the COVID period or being 100% remote that we should keep an eye out? Any kind of new wrinkles on fraud?
It's funny you brought this up, because I circulated an article about this very topic yesterday to some of my colleagues here, and and again, it's not speaking to any of our clients in particular. It's us and any kind of enterprise, and it was a topic of fraud that's perpetrated by internal sources that people don't sort of consider. So yes, it's like unscrupulous employees, and there was multiple examples of people that use fake invoices or diverting or changing payment recipients, and sometimes those individuals were collaborating together. So, again, I'm not pointing to any commercial enterprises, including everybody in banks as well too, that is starting to be somewhat more overlooked from a trust factor. It's always, there's some sort of outside entity that's doing this to us. So I would just say there's sort of a body of knowledge that doing an entire sort of fraud readiness assessment really needs to include a hard look at like your internal people and processes for everybody.
Well, that is a great call to action and a great way to finish. Joe Watkins, this was fantastic. Thank you for bringing this knowledge to us. Mary Garcia, as always, thank you for being a partner of the CFO Council. A copy of this presentation and a link to this recording will be sent out later, and you'll be my new best friend if you like, comment, and share once I post something about this on LinkedIn. Thank you all very much, and everyone have a great day.
Thank you, Robert.